the sexy strategy isn't always the right one. Yep, it's great to be able to stand around at the barbecue and talk about some, Chinese EV stock that only you picked and it's 10x or 100x or 1000x. I can assure you that is not the case. You are not going to be able to do that. And most of the time when people are talking about that, they are lying. Welcome to Checks and Balances, brought to you by Lighthouse Financial. I'm Michael Vincent. That's James Blair. And today, intensification versus diversification.
We're back in your life and we're intense guys, Mike.
I'm a pretty diverse guy.
I don't know what to say about it. So this topic today, we see it with a lot of our clients that we talk to where they go, all my money's in property. I think I should diversify into something else. And we'll go, no, that's a horrible idea. You should keep doing what you're doing. Or on the flip side, we had one client or potential client come to us and they were like, I've been taught by this online guru that I shouldn't diversify the money that I have. I should just pick 4 stocks because if those 4 stocks do really well, I'll make lots of money. And I'm like, oh yeah, that makes sense if that happens.
Yeah. And I think there really what they've done is just pick the wrong online guru. You're looking at them here. Diversification is a strategy that we push a lot at Lighthouse, right? And the fundamentals of that are, you're spreading some of your risk across different asset classes, locations, your different risks. However, generally speaking, diversification does mean a slightly lower return because you're not as intensified if something does pop off and do really well. Now, why does this matter, James?
So, intensification is really just going, I'm all in on this thing.
Yeah.
And if that thing works out really well, you're going to make a lot of money. If it doesn't work out really well, you're going to lose a lot of money. Diversification is much more about playing the long-term averages, which when we're talking about investing in a way with our spare cash flow into property or into shares, that is going, we're not experts, we just want to take the averages.
Yeah, 100%, right? So if we look at diversification in the share market, that might be a strategy like investing into the S&P 500, where you are investing into a basket of shares, a basket of companies across a large range of industries, sectors, geolocations, a whole lot of different aspects to those shares that you would otherwise have to pick individually.
Yeah, however, I would counter as well and go the S&P 500 is not really that diversified because I think it was like 25% of the growth of the S&P 500 last year was just NVIDIA. And obviously those tech stocks have very high weightings. We actually did an episode, which we'll put in the notes around, is the S&P 500 a diversified fund or not? I would go, if you want to be exposed to lots of different assets, right? So US markets, Europe, emerging markets, New Zealand, Australia, bonds and property funds, etc.
Do you want to be exposed to New Zealand?
Mate, everything comes back around and New Zealand's going to be hot property again soon.
All right, so then we'll go and jump into what is intensification in the share market.
Cool. So it was that example I gave before where you think that you have the ability to pick winners and it's more or less trading a portfolio, I guess, where you're going, opposed to taking the average of 10%, I'm going to be invested into fewer companies that will give me a much higher return. I think you see this also with like the crypto space as well. It is very bloody close to gambling because the average person, are they doing enough research where they understand the strategy, the CEO, the direction of these companies? Or are they just taking a punt because fundamentally they're being lazy, they don't want to do the work and they want to get rich quick?
I think that where people fall into a trap here is hindsight bias. And they look at 4 stocks that have done really well and they go, you know what? If I had invested $1,000 into each of these 10 years ago, I'd be a millionaire by now. So what I'm going to do is take my sum of money and put it into those stocks because I believe that the trend will keep going. And you know what? Sometimes that is a self-fulfilling prophecy. And we are seeing a little bit of that at the moment where a lot of the gains in the share market are effectively sentiment driven.
Yeah.
The fundamentals, the price to earnings ratios have completely divorced from the actual price of the stock right now. And there is an argument around there, and this was particularly put forward by the Magellan team the other day, that actually the market's going to run out of gas pretty soon and just be a little bit tired. We're not going to expect those returns going forward. However, I think that a lot of the time people fall into hindsight bias. They chuck that money in. And remember, guys, past performance is what?
not an indicator of future performance. Nvidia is a really good example of this, where the price to earnings ratio is completely out of whack. So to justify their valuation, Nvidia needs to grow 20% a year for the next 20 years in a row. Now, when you think about that and then apply compounding interest, it hurts your brain. The normal brain cannot comprehend how big of a number that is. So if you go and put money into Nvidia at this point, you have to feel very, very confident that they're not just going to be bigger, but they're going to be astronomically bigger in the future.
100%. So it's not all negatives. There are some pros to this as well. We'll dive into the pros and cons after the break. James, I've got a lump sum of money. I want to throw it all into Nvidia because I know it's going to take off. What should I do?
Don't do that. What you should be doing is having clear goals for the future, setting a financial plan, working out what the right thing for you to do is. If that sounds like a plan to you, reach out to Lighthouse Financial. We can talk about your situation.
Now back to the show. All right, James. So the pros and cons. Right. Intensification, higher risk, but maybe higher reward?
Yeah, for sure. I think the other bit around intensification, which we need to talk about, one is for those that run a business. So running a business is pretty much intensification. And those who do get really wealthy, what they do is they don't, from day one, diversify all their assets. They're all in on one thing. It grows to a certain point, and then when they've got enough wealth, that's when they do start to diversify it. That is really the big benefit of intensification. The other thing can be seen in the property market as well. Yeah. Some people go to us and go, well, I've got a property, or I've got a couple of properties. I want to start putting money into shares. And especially for those that are building or development kind of background, you might go, I actually think you should keep going here for a bit longer before you look to diversify.
Yeah, we do see that with the property market quite a bit, and some of the long-term property investors where they are all in on property, and it is very difficult for us to get them to change that strategy, even though when they're closer to retirement, it doesn't make sense to hold on to all these properties.
But if you're still far away from retirement, it might make sense to keep going for a bit longer.
Absolutely. Diversification's safer, but slower growth. James, that doesn't sound very exciting.
Yeah, it's really all about playing the numbers and go, I'm not in a rush to get there. I want to do it the right way with the highest probability of success. So I'm going to take my 10% average return of the stock market, my 6% average return on property.
Cool. Let's jump into some real world examples here. So the big one, the one that everyone wants to be, everyone quotes, Warren Buffett. His approach, right? He invests heavily into a few strong companies, and he looks at fundamentals, right? He is a fundamental analysis investor. But you got to remember, if you want to be Warren Buffett, you got to be able to do the fundamental analysis. And I would hazard a bet that the majority of people out there think they're doing it, but they're not doing it right.
Yeah, one of my favorite quotes at the moment is everybody wants to see the view at the top. Nobody wants to climb up the mountain. And I think with Warren Buffett, so Warren Buffett definitely does say invest into the S&P 500, but people go, yeah, mate, but that's a bit boring. I want to do what you're doing. But if you're not doing the things that he does and have done it for as long, you're not going to get the results.
Yeah, 100%. RIP Charlie Munger, absolute legend. My favorite quote from Charlie Munger, all I want to know is where I'm going to die because I'll never go there.
You are the Charlie to my Warren.
Cool. Example 2, Jack Bogle. He's the founder of Vanguard. He advocates a broad market strategy into ETFs, S&P 500, total stock market index, FTSE 100, all of those types of investments.
Yeah, so obviously he's probably got a bit of a conflict of interest by saying that that's a good idea, but he's definitely not wrong to invest in a very diversified manner to make sure we're protecting our downside risk and we're taking average returns over the long term.
All right, so we've looked at a couple of different strategies and the people that pick them. How would you choose the right strategy, James? Give me some key tips here.
So the main thing I would do is really staying away from the whole intensification piece, unless it is tied to you're running a business and you're trying to grow to a certain point. You should be intensifying in your career. That makes sense, right? Like you're all in on your career. You're trying to get more income, whether it's a business or income. The reason that is more important is once you do reach a certain level, you have got something you want to protect. You can diversify at that point. So they're the benefits of intensification. I would say in general, people should be diversifying. People should be doing that. The only other scenario I don't think is a good idea is people like to diversify when they have a mortgage. They like to chip away and invest into shares. And mathematically makes no sense whatsoever. If you're making like a 10% return on shares, you take off 1% in fees, 3% for tax, 3% for inflation. Your net return is 3%. Your mortgage rate's 5%.
Yeah, absolutely. And look, at the end of the day, the sexy strategy isn't always the right one. Yep, it's great to be able to stand around at the barbecue and talk about some, Chinese EV stock that only you picked and it's 10x or 100x or 1000x. I can assure you that is not the case. You are not going to be able to do that. And most of the time when people are talking about that, they are lying.
Yeah, and someone wins the lotto, but let's be honest, it's probably not going to be you.
Yeah.
And if you feel like this is like too good to be true, it's, you're going to get rich quickly, I think you're just being lazy and you're not actually focusing on taking the small fundamental steps over time, which we believe in.
100%.
Okay, much love to Lighthouse for sponsoring this episode. Please make sure to subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.